gentlemen, good day and welcome to Canfin Homes Q2 FY2025 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nidhesh Jain from Investec Capital Services. Thank you and over to you, sir.
Thank you, Sifa. Good afternoon, everyone. Welcome to the Quarter 2 FY25 earnings conference call of Canfin Homes Limited. To discuss the financial performance of Canfin Homes and to address your queries, we have with us Mr. Suresh Iyer, MD and CEO, Mr. Vikram Saha, Deputy MD, Mr. Purav Agarwal, CFO, Mr. Prakash, General Manager, and Mr. Prashant Joshi from Canfin Homes Limited. I would now like to hand over the call to Mr. Iyer for his opening comments. Over to you, sir.
Yeah, thank you, Nidhesh. Good afternoon to everyone, and thank you for taking the time out to join the call. I just touch upon a few important aspects for regarding the performance of this quarter, and then we can open it for queries. In terms of the first thing is in terms of disbursement, we've had a good quarter. There's been a good, satisfactory improvement in terms of the disbursement growth over Q1. In terms of compared to Q1, there's a growth of 28%, and compared to Q2 of last year, there's a 18% growth in the disbursement. In sanctions also, we've seen a good growth. Last quarter, we had indicated that there are two particular states, that is Telangana and Andhra Pradesh, where we have had a negative growth or the growth has not been up to the mark. From those two states also, in this quarter, we've had Andhra Pradesh, which has turned around and it is in the green in this quarter. So only Telangana, we are having a bit of a problem and we are going a little slow because the same issues of registration and there are some, incidents regarding demolitions and all of unauthorized properties because of which the sentiment is a little low. Other than that, in terms of the AUM growth, we have had an improvement compared to Q1 where we ended at 9% AUM growth. We have improved it to 10%. Going forward, we expect that by the end of the third quarter, this AUM growth should be in the vicinity of 11 to 12%, and then going forward by end of fourth quarter, it should be around 13-14%, or we'll try to at least cross that. In terms of the spreads and NIMs, we've had a very stable quarter. Our yield has remained stable at 10.12%, and in terms of our cost of borrowing, as indicated in the last quarter thing, we were expecting a 1 or 2 basis points improvement, which we have witnessed. So therefore, the spread has improved by 2 bits, and NIM also has improved. In terms of the credit cost, of course, we have had a reduction in our absolute value of NPA, because of which our stage 3 provisioning has come down. There's a marginal increase in our stage 2 provisioning. We are working on that. That is one area where we need to work or deliver in the Q3. And in terms of, however, we are sticking to the same guidance in terms of 10 to 12 bits in terms of our credit cost. OPEX has been a slight increase. Mainly, there is one aspect is, of course, a cyclical aspect, where in the second quarter, we announced the promotions and increments and all. But over and above that, in this quarter, we've had a slight aspect in respect of actuarial valuation, wherein we've had, because of a discounting rate, we've had about 3 crores of higher costs coming in. And as we had indicated in the last quarter also, that we are stressing on the SARFAESI actions. So because of that, there's approximately a 1 crore expenses which has gone up because of our legal expenses for SARFAESI and all. And also there is a small increase because of our communications, because we set up our marketing team. We also activated our social media advertising and everything. So there's been a small about 80-90 lakhs increase because of our communication cost as well. So these are the major highlights in terms of the performance. I think along with each of these aspects, I've also guided as regards what we are looking for in the coming quarters. In terms of the spread, we don't expect any deterioration going forward also, because in terms of our sanctions also, we still hold a good amount of sanctions which are at very competitive rates. Another aspect which has recently happened is that we have also got a sanction from NHB for a refinance sanction, which will be at a cost lower than what we are borrowing from banks and NCD and everything. So that also should help us in the third quarter. And so we don't expect any deterioration in our spread, and we continue to have the same guidance of 2.5% plus spread and 3.5% plus NIM. So that's the in a nutshell the performance of the quarter and the guidance for the next quarters. I thank you once again, and I leave it open to the floor for queries.
Thank you so much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Mr. Rajiv Mehta. Please go ahead, sir.
Yeah, hi. Congratulations on strong performance. Sir, my first question is on the increase seen in SMA 0 and 1, particularly in Q2. So Q1 was understandable, but Q2 we have seen even higher increase in SMA 0 and 1. It also indicates a collection drop at the first place. So just wanted to understand why it happened, and is it also in some way linked to, were these accounts more on the side of self-employed home loan or LAP? And if you can comment about the reversibility of this increase in the coming quarters?
Yeah, thank you, Rajiv. This is increase in SMA 0 has been not much, but however, the SMA 0 is mainly on account of a small regulatory change where we had this tendency of customers paying some small amounts in advance, and we used to be up to 1 EMI as advance because of the payments which were received from the customer. So some 1 or 2 small blips like one check bounce and we have to redeposit or something of that sort, those kind of customers would generally, the amount would get covered from the advance. So there was always that impact. But the last one of the recent circulars said that any excess amount has to be credited to the principal. So to that extent, that small flexibility has gone. But that is more of a cyclical thing, because what we are seeing is that when the next notch hits, that whatever 50, 100, 200 rupees small amounts get adjusted and they are cleared. So SMA 0 is not a problem. SMA 1, yes, there has been a slight increase as I indicated. In fact, what we have observed is that our SENP, we have had a slight improvement. The improvement that has come in our NPA also is also mainly in respect of the SENP category where we have seen. So there is no that kind of concern that we see in terms of a segmental issue which can affect our collections. But yes, about 102 crores approximately are increasing our SMA 1 plus SMA 2, which is what we need to work on in this quarter. So this third quarter, we will definitely be focusing on bringing this down. But we don't see a problem in this sense, as I indicated, because it's more of a little like extra effort. We'll have to put it. That's fine.
Got it, sir. And also, what explained that we were able to hold on the portfolio yield? Firstly, you can give out incremental lending rates in salaried home loan, self-employed home loan, and LAP on a blended basis. So what is the incremental lending rate here? And is there any other factor, besides the product mix, which is supporting yields as well on the portfolio basis?
See, in terms of our product-wise pricing, there's been no change in Q2 over Q1. So the main reason for this yield holding up is only because, there's been a slight improvement in our, as we had already indicated, that there's a scope for us to improve a little bit of our SENP, and also there is a little bit of a scope to improve on our LAP. although LAP has not been increased much, it's a very, very marginal thing, but our SENP, which used to be around 28%, now we are having about somewhere in the range of 35 to 38% is the incremental SENP category lending that is happening. So to that extent, our, 0.5% extra that we used to charge for the SENP over salaried segment, that is helping us in holding up our yield.
Okay. And just lastly, if you can just tell us the mix of bank loans in terms of the benchmarking, MCLR, repo, and the other shorter end benchmarks, the composition of bank loans, please.
Yeah. See, last quarter we had a 40-40, breakup of bank term loans linked to repo and MCLR. We've had some, MCLR linked loans we have either, repriced or we have repaid, and that is why now and move to repo linked loans. So we have about 45% of our bank term loans which are linked to repo, 35% linked to MCLR, and the balance we have T-bills and all those things. So basically only 30 that MCLR linked loans are now reduced from 40 to 35%.
And would we be allowed to use the NHB sanction in repaying the MCLR linked bank loans? I mean, is that allowed, or it has to be only used for refinancing of the asset? So, I mean, can we have that arbitrage in our favor when the money comes?
No, it is for incremental creation of portfolio. That has to be there for incremental portfolio that will be assigning and creating.
Okay, not on the existing MCLR loans. Okay.
No.
Okay. Thank you so much, and best of luck, sir.
We will be able to use some other, that flexibility is there to use because we have another 2,000 crore sanctions, so that increases our sanctions on hand. So that definitely, will help us to, free up some more thing which we can use to repay the MCLR linked high cost loans.
Understood. Thank you.
Thank you.
Thank you so much, sir. We have the next question from Mr. Shripal Joshi from Equirus. Please go ahead, sir.
Congress on the recent quarter.
Sorry to interrupt, sir. Your voice is not clear.
Yeah, sure. Am I audible now?
Much better, sir.
Yeah. So my question was on pricing and margins. So it's given the portfolio mix, marginally shifting towards better yielding, and also, there might be some possibility of portfolio repricing. So do you believe that we can actually do a better margin this year than last year?
Yeah, thank you, Shripal, first of all. See, in terms of the pricing, going forward, yes, we will have a little better yielding portfolio which will get created. So that is there, but we'll have to see how we are able to reprice. In fact, it is more likely that we will be able to benefit from the repricing of the liability side rather than from the asset side. That is more likely possible. As I just mentioned to the earlier question also, that our MCLR linked loans and some of our high cost loans, now that we have a higher sanctions on hand, we will be able to, maybe reprice or repay some of our high cost borrowings and MCLR linked loans. And going forward, when the rates start coming down, yes, that will benefit us. So on the yield side, not as much as from the liability side.
Got it, sir. And the second, just on the this SMA 1 and 2 pool. So as you highlighted that it is not much of a concern, but so because typically what we see is that from 1Q in 2Q the seasonality sort of moderates and collections start to improve. But despite that, this quarter has also not seen that. So what are the aspects that you are seeing which is giving you comfort that in 3Q we'll be able to recover this accounts?
As I said, this slight change in this guideline where we are not able to keep an advance or everything, that is in fact giving us a slight, flexibility that we had has gone. So, therefore the flow back is also, if it happens, we are not able to, come back, and some customers always have that seasonality or some delays they keep making, and collection has to be a little more, expensive for some of the segments and small pockets. So those are the ones where we are having it, but we will be deploying more people and we will be, taking some more things. In fact, we have already started taking certain actions for those kind of things. So I think it should not be. My comfort comes from the fact that from 2 points actually as to why we believe that our NPA and gross NPA our collections will improve. One is that in terms of our restructured portfolio, our collections have come down considerably and our NPA has also reduced, which was in Q1 at 18% of the outstanding restructured book, has come down to 17 point something percent in the restructured book. So that is one thing. The second thing is, in terms of, as I mentioned earlier also, our collections or the reduction which has come in our portfolio, that is coming more from the SENP segment, which is generally considered to be a little more sticky. So these are the two aspects why we believe that, it should not, have an impact. And to some extent, yes, the collection efforts that we are putting will also bring in some support. So that's basically the reasons why I believe we are confident that this will not have a problem.
Got it, sir. Got it. Thank you so much, sir, for the detailed answer, and good luck for the next quarter, sir.
Yeah, thank you.
Thank you so much, sir. We have next question from Mr. Abhijit Tibrewal from Motilal Oswal. Please go ahead, sir.
Yeah, thank you, and good afternoon, everyone. Sir, just 2-3 things. First things first, just trying to understand, while this has been a good quarter, I'm just trying to understand how should we look at the industry in general. Why I ask this is, today if you look at the small ticket size or what we call as the affordable housing segment, there we are seeing growth sustain. But if on the other side we look at, some of the large HFCs who are into slightly higher ticket sizes, there is indeed tightness in terms of growth. So, if you could just explain this dichotomy which is there from an industry perspective, and then a related question that while for the full year FY25 you've guided for 13-14% kind of a loan growth, how is it going to translate into disbursement momentum for the next 2 quarters, and then will we be gunning for higher loan growth from next year onwards?
Yeah, sure. See, first of all, yes, to your first question regarding the segment, that affordable housing companies are doing better and higher ticket loan companies are having an issue. Actually, if you look at our quarterly performance, in fact, the same trend which we had in the first quarter is continuing, wherein our 20 lakh plus segment is where we are seeing the growth. And even if you look at the simple fact that the cost of construction also today, even in the smaller tier 2 towns, the property values are not anywhere below 25 lakhs. So affordable segment, it's a different segment that, you have a segment of unbanked or maybe all those kind of appraised income where formal income segment is not there and all. But in our case, in fact, it is a 20 lakh plus segment where we are seeing the growth. So I don't see any issue in that. And as I also mentioned in the first part itself in the opening remarks, that our growth is, in fact, we have witnessed across geographies except for the state of Telangana. So even Andhra Pradesh, we are seeing the same trend that across the board we are seeing the growth has come from the 20 lakh plus segment. So I don't see, maybe could be some other reason. And we don't see that kind of a thing. Even in terms of sanctions, if you see, our growth has been very strong in the Q2 compared to Q1. That's the reason we believe that there is a good amount of scope and we don't expect the thing to come down. That is the first part. And in terms of the guidance that we are talking about 13 to 14%, see, normally first half, it's a 45%, and second half we witness normally 55% of the disbursements happening. That's the general trend. The second half is always better. Now, if you go by that, we have already done about 4,500 crores close to that we have done in the first half. Going by that argument, another 5,500 crores is anyway is what it should happen even if you go by the past cyclical trend. That plus whatever extra push that we are making is what we believe will bring us to something more than 10,000 crores by the end of the year, which is what should get us the 13-14% kind of a growth. I hope I've answered your question, Abhijit.
Yes, sir, you've answered. So, and we are expecting a similar growth trajectory the next, over the medium term, beyond FY25 as well?
Beyond 25 also, I believe, this trend should continue because we are putting in place a lot of things like, one is we are broad-basing the geographical presence. In last year also we opened branches, mostly it was in the north and west. This year also we are doing it. So basically one step we are taking is we are broad-basing the geographical presence. The second thing we are doing is, we have opened up segments like, as I mentioned, this SENP slightly improving. We are also open to a little bit more of LAP, although which is right now only about 5%, and this quarter has not seen much. Plus, as I mentioned, we have initiated the activities for marketing. We have also set up a small marketing team and all. So going forward, all those things should translate into better business and a more sustainable business going forward beyond FY25 also.
Got it, sir. And sir, the second question I had was, again on asset quality, a lot of discussion has already happened on SMA1 and SMA2. But my question was more generic, given that in the last maybe 1 or 2 quarters, right, there are banks, there are NBFCs, right, who started talking about more of a broad-based kind of a stress that we are seeing in both in retail and SME. However, having said that, right, we are not seeing, we are not talking about that stress in the housing segment or the mortgage segment today. So just trying to understand, are there any indicators which would suggest that some of this stress which is there in unsecured today can spill over to the secured segments as well, like mortgages?
In terms of the unsecured segment, obviously there has also been some regulatory tightening, and that also would obviously have impacted the repayments and everything, because a lot of it is more, one loan lent into the other, which is exactly what the RBI pointed out. In terms of a housing loan, however, that particular tendency is not there. So I believe, you cannot compare, the unsecured loan vis-a-vis the housing loan, and particularly when you are talking about a self-occupied residential house that we are talking about. Unlike, the personal loans and short-term loans, which are more for consumption or for, investment and or speculation or whatever. So these are two completely different segments. So housing loan should traditionally also, reflect a better and repayment compared to the personal loan and short-term loans. And that is precisely what, since our self-occupied residential is what we are mainly focusing on, therefore that is something which is not yet reflected.
Got it. And then my last question was, while you've already given out your bank term loans, what is the mix between repo, MCLR and T-bills? Just trying to understand, hypothetically speaking, right, let's say if there is a 25 basis cut in the repo rates, how will and over what duration will that translate in our liabilities? In other words, out of 25, what proportion will reflect in our lower cost of borrowings and over what period? And commensurately, having seen so many cycles, typically, is it the case that, in the initial part of a rate cut cycle, margins will be under pressure and then they will pick up as things go along?
As we mentioned, about 60% plus of our borrowing is through bank term loans, and about 45% of that is linked to repo. So any reduction in repo will immediately translate in about 25% of our book on the liability side, which will experience a 25 bps benefit. So which means, if 25 bps reduction is there, then we will be in a position to pass on somewhere in the range of about 10 bps max to the down the line to our customers. And we have already moved effective January. Last January we moved our reset cycle from annual to quarterly. So on a quarterly basis, we will also pass on. And we have in the past also been very fair, and we have passed on immediately without any lag, much of a lag. So at most, if at all there is something, it will be for a quarter that we may be enjoying a little bit of a benefit in terms of the interest rate. And as soon as the repo rate cut is announced, the banks will have to immediately pass it on to us. And we will, at the next reset cycle, which is in a quarterly cycle, we will also pass it on to our customers, obviously on a pro rata basis, which is 10 paisa to 25 paisa kind of a thing.
Got it. So, sir, just to clarify that, is that, when there is a 25 basis point cut, depending on how it affects your cost of borrowings, on a pro rata basis, on a proportionate basis, you will be passing it on, because our home loans are not really linked to repo.
Yeah, we are not required to link it to EBLR.
Got it. Got it. This is all from my side. So congratulations on a good quarter, and I wish you and your team the very best.
Thank you, Abhijit.
Thank you so much, sir. We have next question from the line of Ms. Shweta from Elara. Please go ahead, ma'am.
Thank you, sir, for the opportunity and congratulations on a good quarter. I just have one question. So while you were alluding to growth targets of 12 to 14%, one, what is the growth target for next year? Two, how much steadiness do you see on the repayment scenario? And if you could throw some color on BT out cases. Thank you.
I think I missed the second question, not very clear, but I'll just answer. See, first of all, in terms of our BT out, it is just about, we have a total close to 3.75% quarterly repayment which is happening, which comes to somewhere around 15% for the entire year. Breaking up into our how much is part prepayment, how much is amortization, and the rest is closures and BT out. Our BT out of that 15% is about 4%. 4.5% is out of the closures and BT out. The remaining 10.5% is either part prepayments where customers continue to service the balance portion of the loan, or amortization impact which is there. And growth for next year, I think we would continue to have about 15 to 17% is what we would aim in terms of the AUM growth.
Sure, sir. Thank you so much and good luck.
Thank you.
Thank you. We have next question from Pawan Kumar from Ratnatraya Capital. Please go ahead, sir.
Sir, I wanted to understand what are the new geographies that we are entering in terms of number of branches. Do we plan to increase the number of branches? And what will be the strength of our sales force team as of now? And what are our internal targets about how much of the new business can be sourced through our own sales team?
See, in terms of a branch expansion, we are planning for another 15 additional branches in this financial year, and this would be mostly in the north and western geographies. In terms of a sales force, we don't have a dedicated sales force in a large sales force. We have just started a marketing team, a sales team that is, and we have a very small team. We are just experimenting in the north and west mainly. So in a couple of states we are doing it. So we don't have much of a sales force presently in the on-ground kind of a thing, which we, however, will be building as we go forward. So this is a small pilot which we have done, and this has started showing some results. In the long run, we expect about 20% of the business to come through this sales channel. And our sourcing should come down from the present 80% to about 60%. That's the breakup. 60-40 is our goal which we expect to achieve in the next 2 years. By FY27, we expect to bring it down to 60-40.
Okay. But aren't we planning to hire new people from the market for our marketing as of now?
We will be either from our existing teams wherever possible, wherever productivity limits are allowing us. We will take from our existing teams also. Otherwise, yes, we are open to in fact slowly build our sales force through lateral hiring.
Okay. And one last thing, what are the new states that we are entering?
Sorry? I missed
the new states you were talking about in North India that you were entering. So I was just curious on what are
We are not looking at new states. We are already present in almost all the states in the west and the north. We will be expanding or going deeper in these geographies basically. Like last year, we are already there. Like last year, we opened branches in Bikaner, Pali. Then we have in Ratlam, Ujjain. We had in Saharanpur and Meerut and so on. So basically, we'll be in the existing geographies. We are looking at deepening our presence and opening offices in tier 2 towns.
Okay, sir. Thanks. I'll get back in the queue.
Thank you, Pawan.
Thank you so much. We have next question from Anusha Raheja from Dalal & Broacha. Please go ahead.
Is it audible?
Yes.
Yeah, sir. So, what is the incremental average ticket size of the loan?
Average ticket size, we've not seen much of an increase in our ticket size. It's still hovering around 25 lakhs.
Okay. On a blended basis, what will be the average ticket size?
Oh, that's what I said. On the blended rate, it is about 25 lakhs. But we are seeing more of a rise in the 20 to 30 and 30 to 30 plus segment. And yes, so it's a little in the decimal increase would be there, but otherwise it is in the 20 to 30 and 30 plus segment only we are seeing a growth. And average ticket size is around 25, which should inch up to around 27 in a year's time or something.
Okay. And sir, on the margins, if I have to sum it up, you said that there could be positive traction on the margin side that will come more from liability repricing. But if but in a declining interest rate scenario, we are in a competitive world. So even banks are also there in the similar set of loans. So if banks bring down their rates on the home loans, is it not possible that you will also have to bring it down, and so that might result in the stable margin profile?
See, there are two things to this. First is that, our reliance on deposits is a very, very small percentage. We have less than 1% or thereabouts in terms of our deposit reliance. So therefore, our main cost of borrowing is impacted mainly because of the bank borrowings, NHB refinance and NCDs. Okay. Whereas in terms of the banks and some of the larger players, their reliance on deposits as a source of funding is much, much higher. As a result of which, today, looking at the rates at which the deposits are being raised, definitely the incremental cost of borrowing is unlikely to kind of come down. So the flexibility to reduce the rates, I feel it will be a little less for some of the bigger players as compared to us. And in our case, anyway, we, if the competition is not reducing the rates, obviously we would not reduce the incremental lending rate, except for the whatever rate benefit we have to pass on to our existing customers.
Okay. So any qualitative aspects, how much could we see a margin, traction or the expansion, some broad, view there?
Our endeavor would be to, repay some of our high-cost bank borrowings or things like that. But of course, I wouldn't, I don't have a number right now readily available as to how much will be, because it is obviously also a matter of how much we can discuss with the bank, because it's a long-term relationship we have. And so it's not going to be very aggressive, but yes, our endeavor is going to be there. We will try to negotiate, and if possible, if banks willing, we will be able to reduce it. Otherwise, we will have to also look at it. But I don't have a figure, but that is one avenue which is open to us to kind of bring down our cost of funds.
Okay, sir. And just one last thing on the mix of the loans between self-employed and salaried. We are seeing a good traction on the self-employed segment. So any ideal mix that you are aiming between the two?
Yes, actually we had about 72% salaried and 28% self-employed, but incrementally it is right now around 35% or there, about 35-38% is coming to self-employed. But on the overall mix, we are still closer to the same 70-30 or thereabouts only. We are open to go up to 65% in the salaried and 35% in the self-employed in the near-term range. And in the next 2 to 3 years, we are okay up to 65-35 on the AUM basis, of course.
Okay, just one last question, if I can squeeze in. Sir, you said that you would be opening closer to around 15 on branches current fiscal. So, can we expect a similar sort of trajectory over the next 2 to 3 years time frame, that this expansion will continue in FY26 and 27 as well?
Yes, we are looking at around up to 300 branches by FY28. So we will be looking at around 15-20 branches in the next years as well.
Okay, sir. Yeah, thank you.
Yeah, thank you.
Thank you so much. We have next question from Antariksha from iPro. Please go ahead, ma'am.
Hello. Yeah, am I audible?
Yes, you are audible.
Yeah. Just one small question. This is regarding this 4th October draft circular by the RBI, regarding similar lending by group entities for banks where they're proposing not to do similar activities under different related group entities. Any conversation with your parent or any discussion on comment that you would offer?
Not yet, because right now it is still at a draft stage. So I believe all the banks have been given time till November 21st or something to give their feedback. And I believe there is already a thing that, looking to the kind of, there is also a little bit of ambiguity in terms of which all segments it covers, because it is not only going to affect housing finance companies, it's also going to affect all the personal loans or this vehicle loan companies. It's also going to affect insurance holdings and stuff like that. So maybe, some more clarity will be definitely sought. And there definitely is going to be some more discussions which may happen before we finally see something coming out of it.
Okay, got it. Thank you. That's all.
Thank you. We have next question from Kushan Parekh from Morgan Stanley. Please go ahead.
Hi, sir. Congrats on the good quarter, and thank you for taking my question. I have two questions, largely around the asset mix. Obviously, you said that you are comfortable with taking salary down to 65% and 35% self-employed. Do we have a similar target mix that we are looking at between housing and non-housing, essentially LAP? And just also from a data keeping perspective, within LAP, could you help us with the collateral share, as in how much would be against residential property and how much against commercial? That's my first question. Should I put in my second question as well?
First I answer this if it is okay. So first thing, thank you, Kushan, for your this thing. In terms of the projected mix for LAP, as I said, for salaried self-employed, we are okay with 65-35. For LAP, right now we are around 5. We would be okay going up to about 7%, because eventually in terms of our excluding, after eliminating the CRE portion of the housing portfolio also, the pure housing we would like to kind of keep it up to around 70%. So keeping that in mind, we have a scope to around 2 to 3% of extra leeway that we are currently having, of which we would like to have LAP going up from 5 to 7. So that is one thing. And in terms of your LAP breakup, actually most of it would be housing, though I don't have an exact number right now, but I think we are mostly doing only against LAP also is purely against residential only. Commercial LAP and even commercial lending itself for us is very, very small. So out of the 5%, I think I don't think it will be more than 0.5%, but I don't have the exact number to be right now offhand.
Understood. That answers my question. And if I can put across my second question, to understand basically on the Telangana part, do you see the...
Your voice is not clear. Can you please repeat the question?
Is it clear now? Am I audible?
Yes, sir. Much better.
So on the Telangana situation, just wanted to understand if you started seeing an improvement in 3Q, and I mean when you say target 100 billion plus disbursements for the full year F25, does that include any improvement in the Telangana situation, or that is irrespective of the current situation there?
See, in Telangana, we have at least Q2 has been quite stable, although we have not had a positive growth. So there is no this thing. But, last quarter we had this issue. So after that, I myself have visited also. So basically, there is a little bit of, discomfort among the builder segment and all, because there have been some demolitions and stuff like that. Obviously, it doesn't affect everybody. But still, there is a slight, cautious approach taken by the developers. So the present, what we are looking at in terms of this disbursement target that we have given, we are looking at a steady state Telangana performance, what is there in Q2, Q1. So obviously, if it improves, that will help us. But I don't know how long this will take, because normally, these kind of things are generally clarified well in advance or quite quickly by the government. But this has gone on this is the second quarter we are experiencing this kind of a thing. So, if it improves, it will definitely help us. Does that answer your question, Kushan?
Yeah, thanks. That answers my question.
Thank you.
Thank you so much. We have next question from Omkar Shinde, who is an individual investor. Please go ahead.
Thank you for taking my question. I wanted to understand, you have mentioned that there is a technology upgrade that is initiated and which will go live by next quarter. So what is this technology change that we are doing and how is it going to help for the business in what sense is this?
We have a present LOS LMS package which we are upgrading in terms of, we are upgrading it. That is the first phase of our technology transfer that we are doing it. So that is something which we have already implemented in the sense that it is already tested. The UAT has been completed. Our parallel run across branches has also been completed. So that is going to be implemented now. Now, once that happens, of course, it will enable us to, in fact, add a lot of other third-party solutions also to it, which already we have quite a few of the smaller modules we have already implemented. Like in the last 2 to 3 quarters, we have implemented the tie-up with Velocity, which is for evaluation. We have tied up with this solution for a little bit of a CRM and marketing. So a lot of things we are already doing. So these are the things which will be possible. So this is the first phase of the upgrade, for which some of the cost aspect has already been incorporated into our expense, because this started from January 24 onwards. So in Q4 of last year plus Q1 and Q2 of this year, the impact of the cost impact, which is about 3 crores per quarter increase, that has already been factored in.
Understood. So is this like some platform-based, like Salesforce or Oracle, something like this, or this is something entirely different it is existing and on top of it we are upgrading?
No, this is an existing one which we have been using for the last many years, almost a decade kind of a thing. On that, we are upgrading because, the vendor has also, with the help of the vendor, we have upgraded quite a few aspects in that solution. Even in the UI UX, we have made a lot of changes. We have kind of made it a little easy for the users to use. And we have also enabled a lot of features like, they have their own CRMs, they have their own kind of thing. So all those things we have done it. Vendor management we have implemented, reconciliation modules we have implemented. So some of these things we have already implemented, but these enhancements that we are doing, which is now going live in this month, that will allow us to add quite a few new modules as well.
Okay. Understood.
This old one. Yeah.
Understood. So what will be what are we looking to gain from? So will this improve the productivity, or how will this impact the business going forward? That is also I wanted to understand.
Sure. See, there are two benefits basically which come from it. One is, of course, as I mentioned, the UI UX. So from the user point of view, a lot of things are already, incorporated. We are also, once this is implemented, we'll be able to streamline a lot of things which are presently being done manually. So that should help us in terms of the productivity. Like once this is done, the CRM module can be incorporated. The Karsai module, which is now being done manually, can be incorporated. Of course, we have done the Karza and we have done this Velocity and all those tie-ups we have already done. But those are operated separately. They can also be incorporated into the same existing module. So the flow which is there, which also will become a little more seamless. This will help the users also to kind of improve. There will be an improvement in our tax to the customers also.
Okay. So what is the current tax now, and where do you see it going?
Right now, also the current tax would be around for a salaried customer about 3 to 4 days, and for the self-employed it would be a little longer, maybe about 7 to 10 days. So we are expecting, from there also, if it's a salaried customer and a high-profile customer and everything is absolutely clear, I think the tax should come down by another 1 or 2 days.
Okay. And finally, with respect to incrementally, we are seeing our disbursement being towards more than 30 lakhs. The share is increasing. What I wanted to understand is do we then see any benefits coming from the PMAY scheme, or will that not affect the business much? Because that the scheme focuses more on the 25 lakhs and below segment, and we are seeing more traction in the 20 lakhs above and 30 lakhs above. So wanted to understand that.
See, the PMAY, once it gets implemented and gets rolled out in a full manner, the demand for home loans also marginally improve. Although this scheme has a much lower benefit compared to the previous PMAY CLSS 1.0. The CLSS 2.0 has a slightly lower benefit, and it is spread over 5 years. So yes, there could be some benefit which would come from it. In the past, whenever customers have come, this would definitely help. The other thing is in PMAY 2.0, the government is also looking at a portal from which the customers themselves can select the vendor or the lender with whom they want to go to. So they have to choose 3 to 5 lenders whom they want to go to, and the data of the customer will go to those here. So in fact, right now it is more of a sales-driven kind of approach where we are doing 20+ segment and all, which is more directionally we are trying to focus on that segment. But here there will be a lot of inbound kind of a demand which will come to us through the portal once it gets implemented. So there, yes, it can help a little bit, but how soon they are able to implement it, we don't know. We'll have to wait and watch. The scheme itself is operational from 1st of September only.
Thank you. Just 2 data keeping points. What is the login to sanction ratio and the sanction to disbursement ratio?
No, login to sanction ratio. Once the sanction is there, it is obviously linked to the stage of construction and to the kind of product. So that is something which we cannot change. If the customer takes 2 months to go to the next stage of construction, then obviously the next disbursement will happen after 2 months only. We are talking about the login to sanction data.
Yes. Login to sanction. What is the ratio? If application was of say X amount, how much of it is sanctioned? And I wanted to understand that.
No, you are talking about the funnel. The funnel, yes.
Funnel.
If you see our data also, that we have about 90% of the cases are getting sanctioned. If you see the sanctions right now in our presentation, our sanctions have been almost 2,600 crores and disbursements have been 2,380 crores. So that's almost like a 90-95% is the flow through.
Thank you.
Yeah.
Thank you so much. We have next question from Jigar Jani from B&K Securities. Please go ahead.
Yeah. Hi. Thanks for taking my question and congratulations on a good set of numbers.
Thank you, Jigar.
A couple of questions. On the OPEX front, because you said that most of the tech investment over the last 3 quarters you have done 3 crores every quarter. Do we see any material change in the cost to income ratios going ahead? Do we expect an improvement? And I believe there was another big project wherein we were trying to kind of revamp the entire IT system also. Any update on that? Because I believe 6 months back we were talking about that as well. And whether that could be taken up in FY26 and correspondingly what would be our cost to income assumptions for FY26. Similarly for credit cost, this year we have seen significantly lower credit cost of 10 to 12 bps. Do we maintain the same guidance for FY26 as well on the credit cost front? These were my 2 questions.
Sure. See, in terms of IT costs, the changes that we made in the last 2 to 3 quarters, they have already been there. As I said, the major component is the upgradation of the present package, the LOS LMS package, which is approximately about 3 crores per quarter. And that has already come into the picture from January onwards. Yes, there are a lot of small packages which we are, also incorporating, which we are also doing it. A lot of it is, already comes in with it's part of the upgrade that we are already doing. So it will not have very much impact in terms of the cost going forward, at least not the phase 1 that we have seen, which already been factored in. Okay. Second thing you mentioned is your question was regarding the major IT transformation project which we had done. So we had an RFP which was floated, and we have already received 6 bids for it, and we are right now under the evaluation stage. We expect to close that by end of December and award the contract to one of the SIs. Once that is done, the project is estimated to take about 9 to 12 months. So it is not, I would say probably somewhere in the Q3 of next financial year is when we will see it implemented. Obviously, I don't know the cost because, till we open the bids, we don't know what is the cost expected. But at least what we believe is that, a major component would be the capex. So OPEX would be somewhere about 30 odd crores, 30 to 40 crores would be the actual cost which would be there. Presently, we are already spending about 15 crores as OPEX in terms of the IT. So if it goes to about 40 also, about 20 to 25 crores is what we expect the incremental OPEX on an annual basis to go up. Once the new scheme is implemented, the new IT project is implemented somewhere in by the end of December 25. So that is the point. As regards the credit cost, yes, traditionally looking to the kind of portfolio, the kind of NPA ratios and all that we've had, where our gross NPAs have always been below 1%, and we are right now also in the same phase. So going forward also, I think that should eventually work out to around 10 to 12 bits in terms of credit cost only.
For the project which we had mentioned last time.
Hello?
The capex estimate was about 60 crores, right? For the IT project.
That was so initially when we had looked at the first RFP, our budget was around which we had announced into 2022, which we actually didn't go through. At that time, the cost was about 60 crores would be the capex, and then about 25-30 crores, 30 crores approximately for a period of 7 years would be the OPEX. That is what was the initial approval which we had taken from the board and which was the kind of expectation there. But as I said, since then 2 years have kind of elapsed. So we are not sure as to what would be the cost. But yes, I mean, if you look at the simple, but IT costs have gone up. So we are not sure whether it will be in the range of around 300 crores instead of 250 crores or it would be around 350 crores. So that would be the kind of range. I don't expect it to be beyond that.
So 250 to 300 crores should be the total cost.
This is the 300 crores or something is what I'm saying about is the OPEX plus CAPEX over a period of the next 7 years is what I'm talking about. Which was earlier 60 plus 30 over 6 years or was somewhere around 250 crores, which probably could be around 300 crores. So if that happens, probably